And on Tuesday, the MBS were up 11 basis points early. Treasuries were down 13. Stocks down 25 points very early. After being closed for May Day holiday, European markets were back in action this morning. Data highlights included weaker German retail sales, generally flat manufacturing PMIs, and an unexpected drop in core inflation against the backdrop of higher headline CPI in Italy. Net effect was a moderately big rally at the start of the European session, one that pulled U.S. yields down a little bit. The Fed starts its meeting today, and it will break and release its rate and policy statement, followed by Fed Chair's press conference tomorrow. Right now, markets are priced in at a 25 basis point rate hike after this meeting, and all eyes will be looking for signals if the Fed will now pause after what will be its 10th rate hike in a row. Market trade are pricing in a pause after this hike, with the Fed rate expected to stay at 5% until November before seeing a couple of small hikes by the end of the year. I don't agree with that. Fannie Mae announced its results this morning. In its first quarter of 2023, it had $3.8 billion in net income for the first quarter of 2023, with net worth reaching $64 billion as of March 31st, 2023. Net income increased $2.3 billion in the first quarter of 2023 compared to the first quarter of 2022, primarily driven by $3.2 billion decrease in provision for credit losses. Interesting. $78 billion in liquidity provided by the mortgage market in the first quarter. That's an awful lot of money to make when all the other participants are losing money, yet they can't seem to ever come up with any money to back their affordable housing issues. It's quite interesting. They're by far the biggest gorilla in the marketplace. They think it's super important that we increase our money-losing lending operations, but they won't kick in on that even though they made $3 billion in the quarter. Anyway, the number of job losses decreased to 9.6 million according to the JOLT survey. This was down 384,000 from February and 1.6 million from December 31st. The quits rate, which tends to predict wage inflation, fell to 2.5%. The quits rate was 2.9% a year ago. Construction spending rose 0.3% month over month in February. According to the census, this was up 3.8% compared to a year ago. Residential construction spending was down. It is interesting how much single-family and multifamily spending has diverged. Bonds completely erased yesterday's snowball sell-off with an even bigger snowball rally. By mid-morning hours, motivations were twofold. Drama began at 9:30 as bank stocks began to tank, ultimately resulting in several of them being halted. Treasuries were already following that flight to safety trade when the JOLTS data came in on the soft side, further underscoring the potential cooling in the labor market. For those powers combined, bond buyers scurried to get into position for what suddenly looked like it'd be a friendlier Fed meeting tomorrow. Day of the day, MBS were down 19 basis points. Stocks were worse by 48 points. 10-year Treasury lost 16 basis points, with the 5.5 UMBS ending up at 100.64. It's getting real messy right in there. So we have a convergence of three different trend lines, being the red Fibonacci, the pink 100-day moving average, and the red 25-day moving average, all right in there with a ceiling, another ceiling at 100.852, and then a floor down at 100.426. So we have plenty of room to the downside, but a lot of support to the upside. So all that's kind of leaning towards locking in my world. Separately to all this, we got the Fed's review of the Silicon Valley Bank situation. It basically lays the blame on deregulation and limiting the regulatory burden on the banking system. In the interviews of this report, staff repeatedly mentioned changes in expectations and practices, including pressure to reduce burden on firms, meet a higher burden of proof for a supervisory conclusion, and demonstrate due process when considering supervisory action. The report added in that this may have, in some cases, led to staff not taking action. It's very interesting to find that the fact that the Fed didn't consider the scenario of rising interest rates in its stress test to the biggest banks in the world. So the Fed didn't think that there was a possibility of raising interest rates when tomorrow will be the 10th time in a row that they did that. So I think that's one of those situations where every time you point a finger, three are coming right back at you.